All right, Russ. I'm so stoked because right before we walked in here, I handed Maddie my check for my premium that was due in another week.
That's a different way to think about it. You said you were excited about that. I remember the first couple of premium that I made, when I first started doing this in 2009, 2010, and I wasn't excited to do that. Why were you excited?
Dude, that's a mind shift. It absolutely is a mind shift because when I first started, I was thinking about it like an expense. Like, I've got to pay this. Can I possibly keep this up? Like, those are the thoughts going through my mind. And now, obviously, I see it in a different way. I'm now, I think, 7 years into this particular policy. And it's actually one I own on someone else. It's a whole nother podcast. But I'm just stoked because that dollar is now going to be growing by more than what I put in it.
I think that if you have not explored the whole concept of infinite banking and how we use life insurance policies as a financial tool, right? This
That's
is
right.
just a tool. This is not an investment. This is literally a tool for our cash. This is going to be a great episode for you to dig in a little bit because we do break out how do I pay premiums? Like do I think about it like an asset, like you're thinking of it, or do I think of it like an expense?
Well, and also looking for ways to find additional dollars to pay premiums. If those are questions you have, you need to tune in. If you're thinking about like, well, maybe I can't really pay a monthly premium, but I could do an annual or something. We talk about the different strategies around that.
Well, I think I remember back to the very first couple policies I used to do. I would just actually do them monthly because I couldn't even fathom paying the premium all at once. And I think really it had more to do with where I was in life.
Yeah.
And also me thinking about giving up access to those dollars where like what you're saying now is that paying an annual premium, one, is easy to do because the money is really just moving from your left pocket to your right pocket.
That's right.
You can access it immediately. And we know that there's some discounts there. But also during this episode, Joey, I think the beauty of what we start to uncover is how and where to come up with some of those dollars to pay those premiums.
Absolutely. And I this is something else just dawned on me as we're talking. Why is the mind shift set changing here? It's because now we've got all these places that I have to put money to work, right? Our short-term rental business is blowing up. I need to have access to capital to put back into that. So I'm like excited to fund my policy so I can turn around and roll it right into the next short-term rental.
No doubt. All right. So let's get into this because I think this is going to be a good episode. If you're joining our podcast for the first time, remember this is our Tuesday episodes where we focus on the concept of infinite banking. If you're kind of new to that, this is a good one. And we welcome you to the roundtable. Let's belly up.
Welcome to the Wealth Without Wall Street podcast, your guide to understanding how to get out of the Wall Street rat race and start your own mailbox money lifestyle. Now, don't let these handsome Southern draws fool you. These financial minds are teaching our country to enhance savings, increase cash flow, and create passive income, all without the help of Wall Street. Are you ready to break through? Now here are your hosts, Russ Morgan and Joey Murray.
Welcome to the IBC Roundtable, where we are breaking down the conversation today about how can I pay premiums, and I promise you it's got to get cooler than that, Ernie. I'm sitting next to downtown Ernie Brown. How you feeling today, Ernie?
I am. I'll be honest, I don't feel awesome.
Ernie had a battle this week and lost it.
I lost the battle.
What happened this week, Ernie?
I concussed myself.
Hit your head on the floor.
I was flossing.
He was dancing?
Nope, no dancing.
You were physically flossing your teeth.
Flossing.
You fell to the ground and hit your head.
I'm not proud of it.
Now, I'm not saying you should be proud of it. I'm just saying that's why you're a little slower than normal today.
A little bit, yeah.
Okay. Well, I appreciate you being here.
But I'm glad to be here. Good morning, good afternoon, good evening, or good night.
On the other side of the round table, we've got our resident pilot, Mark, the Gooch, the man between two bamboo. How are you, Mark?
I'm doing great, guys. I haven't concussed myself in a while, so I'm feeling pretty good.
Well, I always feel concussed when I'm waiting on my my friend, my partner, the Italian stallion, Mr. Joey Murray. How are you doing today, Joey? You're a little further away today than I would like.
Man, I'd say strong to quite strong, except for the audio blunders. So other than that, strong to quite strong.
That's all right. And lastly but not leastly, the $1 million smile, Mr. JD Hill. What's up, JD?
How's everybody doing?
We're good. I'm interested to hear your thoughts today as we start off our topic on paying premiums. There's lots of ideas behind this, and sometimes people want to know, when we're talking about the subject matter of infinite banking, we're talking about putting money in cash value life insurance. The question always comes up, well, how do I do this? How do I pay my premiums? How much should I put in? What should I start with? And they come and they talk to you. How do you help them solve that mystery?
That's a really good question. And, you know, there is not necessarily a one size fits all. But, you know, I encourage people just to put all of their income into premiums as much as possible. No, I'm kidding. Joey actually did do a great video on that. But I think when it comes to how much you should put in really determines, I think, your mindset and understanding of what it is that you're actually building and designing, right? Because you're building a system, right, in terms of what IBC is. And I think once you get your arms around what that is, then how you fund it and the amount of dollars that you're using to fund it with becomes so much more clear.
So, Mark, when you hear the word premium, what are some of the first thoughts that comes to mind?
Top shelf.
It is. I mean, explain that a little bit more, because I really feel like when we get kind of engrossed or encapsulated in this conversation, we automatically think of insurance, right? We think of insurance premiums. This is what we put in, deposits, whatever you want to call them. But when the word premium is thrown out and just no context to it, yeah, I think people could think top shelf, high end.
Or either that, or it's the coach seat on an airplane that they just put some lipstick on. They called it a premium economy seat, so you pay a few more bucks for it.
That's right. You don't get anything else. It's just a little bit more forward in the cabin.
Yeah. But no, yeah. I mean,
leave it to the pilot. Leave it to the pilot to bring up that analogy. You know, that's perfect.
I'm in the wheelhouse here. This is what I know.
Well, so when you think of Joey, we oftentimes are trying to help people figure out what is a better way to think of premiums. What are things that you come and share with people?
I think, first of all, I think you have to remember, partly, you know, you and I have been doing this so long, it's hard to remember sometimes what we came from and the mindset of what premium has this connotation in general is this expense. It's this, like you said, top shelf, Mark. But at the end of the day, we've kind of shifted that mindset over the years that this is a deposit. Like, this is an opportunity for me to store cash, and it's only getting better with time. So I think of it as like, man, I'm planting a tree. You know, I actually just got off the phone with one of our clients, and he's like, you know, the best time to plant a tree is 20 years ago. Of course, he's in forestry, so he's thinking the same way Nelson Nash did. And he's like, the second best time is today, because we were talking about an opportunity at the beach and stuff. But anyway, my point is, I'm planting a tree, man. This is an opportunity. I can't wait to put that money in as a deposit, and how much more can I put in? So anyway, that's how I think about it.
Ernie, Nelson had 3 defined rules or principles to doing infinite banking. The first was you got to think long range. And the second one was, do you remember?
I was aware of 2 hard and fast rules, and that wasn't one of them.
Okay. What were the rules that you remember?
The 2 rules were don't be afraid to capitalize. So that would have to do with premium.
Exactly.
And the second one is don't take policy loans without making provisions to pay them back.
Don't steal the peas. So he had 3 rules. First was you got to think long range. The second one was
don't be afraid to capitalize.
Don't be afraid to capitalize. Don't be afraid to put money in, right? So when when we think of capital as it relates to life insurance policies, how do you talk with people who are reaching out to us to those 15-minute calls and are wanting to know, as they go deeper into this process, how much capital should I put in? What is the mental gymnastics that you guys go through, or the physical, like going through their budget line item by line item? How do you help them come to the number of how much capital should go in?
I think there's two things to be done, and it sort of fits in with our steps. Is one, we've got to get clarity. What's going on right now, but what are we trying to get to? So there's the two ends. Where are we right now? Where are we trying to get to? So when we talk about what should we put in, one part of the question is what can I put in? But then I think back to Nelson saying, when you go to your system and you go ask for money, one of the requirements is how much have you put in? So it depends on what are you needing to do with the cash? How much should we put in? Well, what can we put in? But then almost as important, or maybe more important, is what are we going to do with it? How much are we going to need? And that's going to be dictated by how much we put in.
So JD, you've been doing this for quite a while, and reallocating or finding money is something that I feel like we do pretty well, right? What are some of those top 1, 2, 3 places that you find that your coaching clients are going to find ways to fund their policies?
Well, I think, where are you currently, like, what does your debt situation look like, right? How are we structuring and paying debt? What do we have in terms of existing cash flows by way of, what are my expenses, and then what's my income? Hopefully there's margin there. Also, are we putting contributions into the stock market, right? Are we funding 401ks or IRAs and doing something that's actually not helping us get closer to our goals? There's a number of different things that we can do to reorient our cash flows to find those dollars without actually impacting your current day-to-day lifestyle, if that makes sense.
Well, Joey, let's break that down, because JD brought up a couple of really good points, and I think it could fly over the heads of some people listening, never considered that they've got certain expenses or certain debts that could be paid a different way, right? I mean, I'm paying it the only way I know how. What are some of the ways in the last 10 years that either you personally, or if you can think of an example of somebody that you worked with, was able to free up cash flow just from an expense, a debt?
I would say, I'm the mortgage nerd of the group here. And the biggest thing that I see is that people are doing what they think is the best. And that is, I got to pay down this mortgage as fast as I can. And there's a better rate on this 15-year mortgage than there was on this 30-year mortgage. They said I could save so much in interest if I switched to a 15-year mortgage. I mean, heck, all these financial gurus say it's a good idea. My mortgage person says I get a better rate. Why wouldn't I do that? And in all actuality, what we're doing is we're paying so much more than we have to towards that mortgage. And it's just creating an unnecessary cash flow away from us. So anyways, long story short, that's a place people can refinance their mortgage and free up tremendous amount of cash flow. Sometimes if they're going from a 15 to a 30, let's say, and now all of a sudden they're like, wow, what do I do with this extra $500, $1,000, whatever the number is per month? I can now start putting that into my control instead of to the bank.
JD, I don't know if you know this. That's actually how Joey and I connected. Joey being in the mortgage industry, and where I was helping people find money, right? I mean, the thing about finance, and we know this just kind of across the board, that the large majority of people are not saving enough money, right? I mean, it's the diet and exercise of finance. They just are overspending, right? And my job initially was always to try to help them find money. Because if I came to you, JD, and I said, look, here's the deal, is that on the path in which you're going today, you're going to end up working until you're 75. You're going to want to retire, and then you're going to realize you can only live off about 25% of what you're making. And you're not going to quit, right? Now, we can try our best to take this 2% of what you're saving right now and earn 20% on it. and maybe you can live off 28% instead of 25%. Because that's not
Right.
going to be a difference maker. Because people believe that finance is about rate of return. It is not. Rate of return is only a small piece of the puzzle. Most of the people out there are not able to get to where they want to because they've not put away money. They're not saving money. They're not looking at finance to what we're talking about of how to create cash flow. So that was something I was pretty good at. And I would look at 15-year mortgages, 30-year mortgages. And there was times where people were creating interest-only mortgages. I'm not an advocate of that, but I knew people that did it. And I was one. And I needed somebody like Joey who could actually facilitate the mortgage closing without trying to, convince them to go back to the 15-year mortgage, because that's what would end up happening. The mortgage guy thought because the rate was cheaper, that's what they needed to do. But what happened is their payment went up, right? People need access to more cash, not less. But it was funny that when I started looking for other ways to help people, I mean, there's some little small things in life that people don't realize. Like Nelson Nash used to talk about this in the book and in seminars. He said, think about if you own your car outright. You don't have a car note on it, but yet you're carrying full coverage on it. That's comprehensive and collision in addition to the mandatory liability. Do you know that you actually can self-insure on the comprehensive and collision? All you have to do, you call your insurance agent up and you say, okay, I know right now I've got a $500 deductible and my payment is $120 a month. Most of us pay every 6 months or every 12 months, but let's, for simplicity, I'm going to go with this. I got a $120 a month premium and I got a $500 deductible. What would my premium be, my monthly payment, if I had a zero deductible, Ernie? What do you think would happen to my premium? If I have a $500 deductible and my payment's $120, what would happen if I dropped my deductible to zero? So the insurance company started paying $1.
Yeah, they're going to raise that payment.
It would go up, right? And we don't know how much, just for simplicity. Let's say it goes up to $200, okay? $200 a month. Well, Nelson said, okay, now you have a mark, right? So why would you not take $200 a month and then, so that's your starting point. Then you go back to your insurance agent and you say, okay, what if I dropped the comprehensive and collision? I only held the liability. And by the way, I don't mean get the minimum liability. That's your state limits, because we need to protect ourselves. So I always encourage people to have high liability limits. We want to protect ourselves there. You want to have umbrella policies as addition. But what would that liability coverage cost me? And they may say it's $50 a month. So now we know we have $150 a month, in essence, that we could put into our own insurance company, right? Because when you start an insurance policy, you're creating a business that never existed. You're creating a pool of cash. And if you put $150 a month into that account, over time, what you're doing is building up the same insurance pool where when it happens, it's going to happen at some point. You're going to hit a deer, something's going to run into you. Hopefully it's not your fault, but what if it is? Then instead of going to the insurance company and filing the claim, right, you're just going to file a claim against your own insurance policy. You're going to pay $1 and you're going to have the cash to do it. And people will say, well, Russ, I don't want to do that. What if I totaled my car? And I would say, well, how many times have you totaled your car since you've been driving? Mark, how many times have you totaled your car since you've been driving?
Goose egg. Although, knock on wood. Thanks, Russ. Thanks for
JD. How many totals do you guys have?
I've never totaled my car, but I may have totaled someone else's car.
Okay. Okay. We got zero for you, one for others. Okay. How many totals you guys have?
Zero.
So right now we got 5 cars because we got wives, right? How many totals have you and Caroline have?
My last concussion was a total.
Okay.
Somebody totaled me though.
Okay, so we now Caroline ever had a car total that you know of?
She has, yeah.
Okay, so you got 2 in your family. So what are we up here? We're at 6, 7, and then Megan has totaled one of ours. So three totals out of 7 total cars, and I don't know if you want to add up all the years, right? So it will happen. It's just very unlikely, right? And by the way, our car was probably worth like $8,000 when we told it. It wasn't like a, $50,000 brand new car. That happens too. But my point to this is when we were trying to find ways to pay our premiums for policies, can we get creative? Are there ways to take dollars that we're already spending out? And that's just a really simple one that everybody has. But you brought up one, JD, which was the money that we send to qualified plans. And that's not a little dollar amount. That tends to be a big dollar amount, right?
Yeah. It is. I mean, it's usually, if you have a reasonable employer, sometimes 6 to 10% of your monthly income, can easily be going towards your qualified plan.
Well, and JD, going back to Joey, when we first met, he was giving the government an interest-free loan for the first 9 to 12 months of the year.
Yeah, you don't have to remind me of that. Yeah, you don't have to keep bringing that up, Russ. He was getting the tax refund, and we figured out what that roughly was every year, and we just reduced and increased his allowances and exemptions on his tax form, and kept more of that money. There's many different ways that we can find cash flow, because what's the objective? How do we do this? But also,
real quick.
Go ahead.
Well, I was just going to say, Russ, you could go the other way too on the car insurance thing. You could increase your deductible, which also lowers your premium.
Exactly. Yeah. No, yeah, you can do away with it altogether, or you can raise it. So I did that on my houses. So on my house, my homeowner's insurance, I have the highest deductibles that the insurance company will allow me to have. And here's the thing is that I don't know how many times we've had an issue with the house or with the cars, and before we ever did any of these things, and it's like I had $1,000 deductible. I took it to the body shop and it was $890. Or I had a $2,500 deductible for the house and it was $2,200. I mean, how many times have we? And what if it would have been $2,700? You think I would have filed a claim on my insurance to get a $200 benefit, but yet know that my insurance premium's going to go up? No. And that's another important thing about the premiums for life insurance. If we compare life insurance premiums to all other types of insurance, think about this. When you file a claim on your car, your home, any type, your health insurance, what typically happens to your premium over time?
They're going to raise it.
Going up.
So those insurances you never want to use, ever. But the way we use life insurance, the more we use it is through policy loans, right? I mean, you can only use it one time for the death benefit. And I don't think anybody's in a super hurry to get that benefit kicked out. But the fact that we're constantly using the life insurance, does that enhance or hurt our situation?
External rate of return.
Right. What does that mean, Joey? When Ernie says external rate of return, what does that mean?
That's what you do with the money that creates an additional return than what's already inside of the policy.
And it's important to think about the use of that money and how these things are different. But there's also some value, Mark, that whenever we're paying premiums, we're not necessarily locked into just one way, right? You can pay multiple different ways. What are some of those ways someone, if they're paying a premium, they've never done this before, and they're like, well, how do I do this? What are some of the different ways they could do it?
Well, the majority of people will start off with a monthly option. So every month I get a notice and off my premium goes. You also have the option to switch it up. You can even go annually. So that now, hey, you know what? I've got my finances in a position where I'm capable of doing it once a year as opposed to 12 times a year.
Well, Joey, I know you and I just early on, as we were working with lots of different entrepreneurs, we found a pretty interesting thing too, that the amount of money that's going toward their base premium and the amount that's going to their PUA doesn't have to be the same. Why does that benefit somebody?
Yeah, I think this is a really unique thing. It's especially the way that people get paid if you have a, a lot of times, I don't know how deep we want to get into the actual structuring of a policy, but let's say that, you have 30 or 40% of your total amount you want to contribute every year into premiums is going to base premium. That very first year, we all know not a whole lot of that base premium is going to cash, right? It's really getting that policy set up from the get-go. There's expenses that are incurred in that first couple years. And so rather than paying the entire premium up front annually and not having access to that 30 or 40%, if we just put in that monthly amount, I'll just give you an example. Let's say the base premium is $30,000 a year. Well, that's $2,500 a month. Rather than me losing access to $30,000 immediately out of the gate, if I just spread that over the course of the year, now I can dump in my PUA, my paid up additions rider, where the vast majority of the cash is available, and now I can get that money at work immediately. So I don't know if I've lost anybody with that, but the point is using the frequency and the mode of how you pay your premium could actually really benefit you in overall getting to your goals. And that's why you work with one of our coaches to make sure that how you do this matches up with what you're trying to get.
Well, here's a question, Ernie, and I think it comes up pretty frequently, is how do I know I can keep making this premium? Because that's a heavy weight, right? Like, it's almost like people say, well, I'm setting up a whole life policy, so that means it's for my whole life. Man, I probably don't want to go too heavy on this thing, because what if I can't make that premium next year or 2 years from now or 10 years from now?
Yes, pretty common. People either start there or they get so excited and they want to do something, and then they think, oh, what if something happens?
Right.
So either way that we get to that point. And I think even our existing clients, we get people who have premiums coming up, and let's say that they've been doing it annually and all their cash is out. And we had one yesterday, probably one of our most active clients come in, and he knew the answer. He was going to take a policy loan and pay that premium. His other option would be, hey, let's just switch this thing to monthly. So really, when we look at that, we've got a premium that's coming due. That's more cash that we can put into the policy. And we want to flex and adjust the mode that we pay the premium to benefit us, and knowing that base premium, yeah, that's what we've got to pay. But that paid up addition rider, we don't necessarily have to pay that immediately. We can pay it through the year. We can even, in some instances, come back later and pay it in reverse. We can catch up that premium. So lots of options. We just have to understand those and keep picking as we go along. What's the best way to get this in?
So, Mark, when you hear the word redundancy as a pilot, what is the last form of resort? What's the Alamo for people flying an airplane if all things go bad?
That's me, baby. I'm your last hope. So you might want to think about buying that ticket next time. No, you've got redundancies built in. You've eliminated single point failure. We have systems that are supposed to protect us, checklists. But when everything breaks down, when it all falls apart, there's really only one thing that's left. And that's the crew, the pilots, the flight attendants, the crew of that plane. And really, if we look at it in our system here, reflected back onto our own personal banking system, what's the final safety measure? It's you, the actual banker. And so it now falls on us to get creative, which is what we're talking about here, right? Get creative, find a way to come up with that premium. Maybe we create an alternative income stream. Kiyosaki had a great one in Rich Dad, Poor Dad, where he was having a conversation with his wife, and she said, oh, I want to, get this car. And he said, yeah, go right ahead. Just figure out how to make the money. And so it wasn't that he told her, no, she couldn't have the car, or, you're on your own, but she had to get creative. And so she went and created income streams to then fund that system. So if she got that car by going out and getting a couple more rentals, that brought in the money to pay for that car.
Well, no, I love that.
So Russ,
go ahead.
I want to jump in there for just a second, Russ. So I like what you're saying, Mark. I like the fact of being creative and thinking through how can I pay this premium. But I think sometimes, honestly, there's a little bit of hesitation if this is the first time you're setting up a policy and you're looking to us and you're saying, well, what's a goal that I should have? Like, is there a certain formula, which I think is funny because we've been trained by the financial world to think in terms of a formula or in terms of a risk tolerance, or like we're just been trained to think that way. So I don't blame you for those questions. But Russ, let's say that somebody is asking that question. How would you give them at least some parameters, at least like a little bit of an idea of what they should be, in a sense, gunning for as setting up this policy?
Well, I remember years ago, I read a book called The Richest Man of Babylon. Have you guys ever read that book before? It's by George Clason, and it's a 100-year-old financial book. I love it because it just has so many basic premises. But one of those in there, he talked about putting that goal to work, to multiply. And like Kiyosaki, you just mentioned Kiyosaki, he never wanted to spend his gold. He wanted to only spend the money in which he was earning from other things, but also then you could spend the earnings of the gold, but never spend the actual gold. Well, when I think about people's finances, I think the gold is the 10%. He said in his book that people should live off 70%, save 10. That's 10% never to be spent. And then 20% would be used to do other things. And that may be to eliminate debts that we have. And I love that mindset of thinking of if I've created a good bit of debts, I could take 20% of my earned income and be applying it to eliminating debts. And we've created a course, Paying Debt Like a Boss, right? And that is, it's got some priority in it. It shows us where to start. But when I think about how we fund life insurance, Joey, I think that 10% should make up the part that we're putting toward the base premium. So if I made $100,000, I would be taking $10,000 and I would be putting it to the base premium. And then I would be working my way up into a position where if I could right off the bat, awesome. If I was not spending 100%, I was only living off 70, then I would be taking that other 20%. I would be putting that as the paid up additions rider. So I would be saving 30% of my income. I'd be taking the 20% would immediately go to cash. And I would be using that to try to either eliminate debts and or using that to buy assets and taking the cash flow from that to eliminate debts or to buy more assets. And I think that's the mindset where I start from. And now, this is sort of like the profit first, and we've covered this on the show before. That's the ideal position, Ernie. And we don't all start in that position because it's so much easier to start something than it is to stop something. And a lot of times we've been programming the way our life for doing something, and so maybe we're only saving 5% of our money. We're spending 95%. So the idea of saving 30% is going to be a little overwhelming. So we're going to have to make small little steps along the way. Creating assets is going to create income, which is going to allow us then that extra income. We can say, well, we don't have to consume all of that. We might be able to save 80% of this new income that gets created, and slowly but surely it moves us toward that 30%. But I just think that this is there's a lot of different ways to pay premiums. I want to recap. Ernie, you gave one is we could actually take a loan against the cash value to make the premium. Mark, you talked about that we could pay our premiums monthly. Joey, I think you said this, but if you didn't, I'm saying it for you. We also have a really last resort where the policy can go into a reduced paid up state, which means no more premiums are required. No more premiums can be made. Obviously, we wouldn't ever want to do that unless we're in a catastrophic situation, but we can do that. We do have an out. It's not a thing that it's going to happen, but I know in your personal situation, Joey, you went from making 300,000 to zero. And you used a little bit of all of those strategies to be able to fund policies.
Well, I was going to say, just from personal experience, before I ever committed to doing a policy, first of all, you have to think about where I was coming from. I was a high earner, but it was 100% commission. And if you've never been in that position, it's scary. I mean, literally the next month, I had closings lined up, I got air quotes if you can't see what I'm saying. And half of those could fall apart. Like, I don't know. I kept saying, okay, how do I start ensuring that those things don't fall apart? But life happens, like things happen. And so I'm sitting here talking to you, Russ, and you're telling me how this works and how it's designed and all this. And I start thinking about, well, how much can I put into a policy? And I'm trying to shoot for as much as I can. And I'm just give my personal experience. I was like, okay, I know I can do 2,000 a month because I already have that committed elsewhere. It's already being saved in some way, shape, or form. But then when you backed up and you said, well, wait a minute, you always have this to fall back on. And at the time, it was 40% of that 2,000 a month I could fall back on, that I only had to pay that amount. That's my base premium. And then when I broke it down like that in my brain, I was like, okay, well, 2,000 may be what I want to do, but I know I can fall back on this. And then worst case, if it came around and I needed to pay the premium because I just ran into a really bad quarter, I could borrow from the policy to pay the policy. And little did I know, 4 years later, I was going to be in a position where I had to do that. I mean, literally, to keep some of these policies afloat, I had to borrow from the policy to pay the premium. And now, 5 years after that, I'm excited that I did that because I never gave up any growth during that whole entire time, and have been able to expand even since then. So anyway, that's just my 2 cents. If you've been in that position, I'm telling you, I've been there, done that, felt that, and experienced even what I would consider the worst of the worst cases, and lived through it, and happy to be on the other side of it.
Well, gentlemen, I think this is a good topic for us to discuss. I know I want to open this up to our Inner Circle members right now. And if you're listening to this podcast and you go, what's an Inner Circle member? That's someone who is a part of our kind of inner mastermind. It's a discussion group. It's a group of people who are using infinite banking and practicing it and are trying to learn from other people. And we built this group specifically to be able to go deeper. Ernie, you've created amazing resources in there. It's where we give access to really insider content. More case studies are put in there, more discussions. And that's what we're about to do. We're about to take this conversation and flow it into that group. If you would like to be a part of that group, you actually can take advantage of a free trial that we have right now. If you go to wealthwithoutwallstreet.com/inner circle, there's a free trial that gives you kind of an inside look as to what others are receiving in there. And we'd love to have you as a community member take part in that. So until our next episode, have an amazing day. Talk to you soon.
This has been the Wealth Without Wall Street podcast. Don't forget to subscribe to the show to break free of the Wall Street mindset and begin building wealth on your own terms in places you understand, so that your wealth will never run dry. See you next episode.